Welcome to the Deep Dive. Today, we're really getting into something significant. The growing wave of institutional investors jumping into Bitcoin and, well, the whole crypto market.
It's definitely a major shift we're seeing.
Yeah, and we pulled together quite a range of material for this. Got stuff from Finovy, Bitcoin Magazine, insights from BlackRock itself, Consensus, Insights4.vc, Finance Monthly, KPMG, Galaxy.
Correct.
Quite the list.
A good mix of perspectives for sure.
So our mission today is basically to figure out, what's really driving this institutional push? How are these big players getting involved? And ultimately, what does this all mean for the future of digital assets? We want to give you some clarity, some actionable insights.
Absolutely. It's gone from being, mostly individual investors to attracting serious capital from established finance giants. Understanding why and how is, well, pretty crucial if you're trying to figure out where this market is heading.
Okay, so let's start with Bitcoin itself. BlackRock's been pretty vocal about it being a strategic asset. What are their main points? Why now?
Well, BlackRock highlights a couple of key things. First, they see Bitcoin as a really useful diversifier for portfolios.
Diversifier. Okay. How so?
Their research shows it has a low correlation, long-term anyway, with traditional stuff like stocks and bonds. And in today's market, that's pretty attractive. Traditional diversification isn't always working like it used to.
Right. So when everything else zigs, Bitcoin might zag, potentially.
Sort of, yeah. It signals they're thinking about Bitcoin's staying power, not just some fleeting trend. It's about its potential place in long-term asset allocation.
Mm-hmm. And the second point?
The second point is its role as a potential hedge. A hedge against broader economic and geopolitical risks. They actually specifically mention worries about U.S. federal deficits and debt.
Okay. So it's less about the typical risk-on, risk-off mood we see in traditional markets.
Exactly. BlackRock points out that the things driving Bitcoin adoption are often kind of the opposite of what drives traditional risk assets. It's tied more to worries about, monetary stability, political stability, rather than just the usual economic cycles.
That makes sense. Now, one really visible sign of this institutional interest is the Bitcoin ETFs. We saw some huge news recently with BlackRock's IBIT fund, didn't we?
It certainly did. April 22nd, 2025, BlackRock's Bitcoin ETF, IBIT, hit a massive $4.2 billion in trading volume. Just record-breaking stuff. Wow.
And that was as Bitcoin's price jumped too, right?
Yeah.
Over $91,000.
Yeah, highest it had been in about a month. That kind of volume, $4.2 billion, it's just staggering. It really tells you something about the scale of institutional capital eyeing Bitcoin now.
It's not just pocket change then. What does that volume suggest?
Well, volume like that isn't just noise. It suggests serious capital being deployed. And it also means more liquidity for Bitcoin, which could, over time, actually help reduce some of its volatility as more big players get involved.
And how would IBIT stack up against the others that day? Was everyone seeing that kind of action?
Not even close, actually. Fidelity's FBTC, that was around $425 million. Grayscale's GBTC did about $251 million. ARK's was $170 million. Bitwise, $120 million. So IBIT was way out in front, a clear outlier.
Interesting. And wasn't there something else about IBIT hitting a peak relative to the NASDAQ?
That's right, yeah. Same day, its performance measured against the NASDAQ index hit an all-time high. That's a pretty significant indicator of growing investor confidence, not just in Bitcoin generally, but specifically in that fund.
And when you see such high trading volume, especially with a price rise, who's typically doing the buying?
Generally, yeah, huge volumes like that often signal strong inflows from institutional buyers. The official net flow numbers come out later, but the sheer scale of trading points strongly towards big institutions being very active.
Okay, but it's not just about ETFs, is it? Institutions are finding other ways in. We're also seeing companies putting Bitcoin directly onto their balance sheets.
Absolutely. That's a really crucial part of this whole picture. Public companies holding Bitcoin as a reserve asset. MicroStrategy is the classic example, right? They just keep buying. Recently added another, 6,556 coins?
They're certainly all in.
Oh.
Any other big examples?
Yes, Semler Scientific is another one. They've got over 1,100 Bitcoin, and they've even said they plan to raise another $500 million just to buy more.
$500 million, wow.
And then there's GameStop. They raised $1.5 billion for something called Project Rocket, which is basically about building up a Bitcoin treasury.
Okay, so these aren't small bets. These are major corporate commitments. What's the signal there, beyond just hoping the price goes up? Does it say something about their view on the tech itself?
I think it does. This kind of direct corporate buying creates real fundamental demand for Bitcoin. It's different from just investment fund flows. And yes, it definitely puts upward pressure on the price, but it also signals a deeper belief, perhaps a hedge against future disruption, like you suggested.
Now, none of this could happen in a vacuum, right? For institutions to get this comfortable, the regulatory side must have changed quite a bit. It's not the Wild West anymore.
Oh, absolutely not. Regulatory evolution has been absolutely key. Getting those Bitcoin and now Ethereum ETFs approved in major places was huge. It gives institutions a regulated, familiar way to get exposure without having to, directly hold the keys themselves.
Right, it takes away some of that operational headache and risk.
Exactly. And alongside that, you've seen the rise of really secure custody solutions built specifically for institutions that deals with the security worries head on.
So the infrastructure is catching up.
It is. Custodians, prime brokers, the whole ecosystem is maturing. And regulators, well, they're actively developing frameworks. They want to provide investor protection, but also create clear rules for how institutions can safely integrate these assets.
It really feels like the walls between traditional finance and crypto are, getting lower. Even traditional banks are using the underlying tech now.
They really are. Banks are looking at blockchain for efficiency gains, better security, lower costs. We're seeing real projects, not just talk.
Like what? Can you give us some examples?
Sure. JP Morgan Chase has its JPM coin using blockchain for instant cross-border payments. Goldman Sachs, they've got a crypto trading desk, offered derivatives. BNY Mellon is offering digital asset custody. Standard Chartered is partnering on blockchain for things like trade finance and tokenized assets.
Tokenized assets, like putting real-world things onto the blockchain.
Precisely. Think digital ownership certificates for things like real estate or commodities, making them easier to trade and manage. So yeah, banks aren't just investing, they're actively building with the technology.
Okay, let's switch gears slightly. It's not all about Bitcoin, is it? Ethereum seems to be drawing a lot of institutional eyes, too.
Definitely not just Bitcoin. Ethereum is hugely important for institutions. A big part of that is its role as the foundation for DeFi, decentralized finance.
Right, DeFi doing financial stuff like lending on the blockchain.
Yeah, and its smart contract capability. Those self-executing contracts just open up so many possibilities beyond simply being a digital currency.
And did Ethereum's big upgrade, the shift to proof of stake, make a difference for institutions? That's the more energy-efficient way of running things, right?
A huge difference. That move to proof of stake really boosted institutional confidence. It addressed a lot of the ESG concerns, made it look more sustainable. Plus, you've got this whole growing ecosystem of dApps, decentralized apps, and things like liquid staking, giving institutions new ways to potentially earn returns.
And Ethereum's leading the way in some cutting-edge areas, like tokenizing those real-world assets, or RWAs you mentioned.
It really is. Right now, Ethereum is the dominant blockchain for issuing RWAs. It holds something like 10 times the value of tokenized assets compared to the next biggest chain, Stellar. That tells you where institutions prefer to build these kinds of things.
Didn't BlackRock launch something specific on Ethereum for this?
They did, yeah. Their BUIDL fund, the USD Institutional Digital Liquidity Fund. It runs on Ethereum, gives investors USD yield exposure, but with blockchain's transparency and, crucially, the ability to connect traditional finance with DeFi. It's a perfect example of a major player using Ethereum's specific strengths.
And stablecoins, too. Ethereum's big there as well, right?
Mm-hmm.
Those tokens pegged to dollars or euros?
Absolutely dominant. Ethereum hosts, I think it's over 50% of the entire stablecoin market.
Yeah.
So yeah, huge amounts of value flowing through stablecoins on Ethereum every day. It's critical infrastructure.
So, okay, beyond pure investment, what else are institutions doing with Ethereum? And those layer 2s built on top of it, the ones meant to make it faster and cheaper?
Right, the layer 2 scaling solutions. This is where it gets really interesting because you see companies that aren't even crypto native building things.
Yeah.
And it's not just finance.
Give us some maybe surprising examples.
Okay, well, you've got luxury brands like Louis Vuitton, Adidas, using NFTs on Ethereum for digital collectibles, maybe authenticity tracking.
Right, NFTs.
Then you have Deutsche Bank developing its own layer 2 rollup, aiming to use Ethereum for more efficient global finance. Sony is launching a rollup for gaming and entertainment. Atari's put games on Base, which is a layer 2. Lamborghini's done digital collectibles on Base 2. Lotte Group in Korea is building a metaverse platform on Arbitrum, another layer 2.
Wow, okay. Gaming, luxury, banking, entertainment. It's incredibly broad. That really shows the tech's potential far beyond just money, doesn't it?
Exactly. It highlights these non-speculative uses, leveraging the transparency, the efficiency, the sort of borderless nature of blockchain for all sorts of real-world problems and opportunities.
Now, KPMG, the consulting giant, they've obviously been watching all this closely. What's their take? And what are they actually doing for these institutions moving into crypto?
KPMG definitely sees crypto assets as a serious investable alternative asset class. They see institutional money flowing in and expect that to continue. So they offer a whole range of services to help institutions navigate this space.
What kind of help do these big players need? What are they asking for?
It's pretty broad, really. Everything from basic education, just understanding the space, to feasibility studies, helping them build a business strategy, designing the operational side.
So the practical setup.
Yeah, exactly. Proof of concepts, due diligence on vendors or partners, figuring out licensing and regulations, which is obviously huge. Then there's help with financial crime prevention, getting ready for audits like SOC attestations, managing treasury operations, integrating with exchanges and custodians.
Sounds like end-to-end support, almost.
Pretty much. KPMG also stresses things like good corporate governance, helping crypto firms potentially get ready for an IPO, ESG support, especially for minors, legal advice, accounting advice. It's the whole package needed for institutions to get involved properly and sustainably.
Okay, this has been a really fascinating deep dive. Let's try and quickly summarize the main takeaways here.
Sure. I think the big picture is that institutional adoption of Bitcoin and crypto isn't just one thing. It's happening on many fronts. You've got Bitcoin being seen as a diversifier, a potential hedge, driven partly by concerns about traditional systems. Then you have the regulatory environment becoming much clearer, enabling things like ETFs and secure custody.
Which makes institutions more comfortable, obviously.
Exactly. And then there's Ethereum playing a huge role with DeFi, smart contracts leading in areas like RWAs and stablecoins. And finally, the underlying blockchain tech is being picked up by all sorts of industries for uses far beyond just finance or speculation.
So wrapping this up then, what's the big question this leaves us with? What should you, our listener, be thinking about as this trend plays out?
Well, I think the really provocative thought is this. How is all this institutional money and activity going to reshape not just crypto prices and stability, but the entire financial system? As TradFi and blockchain get more tangled up, what new opportunities does that create? What are the new challenges? For individual investors, for businesses, for the economy as a whole, it's a massive shift underway. And understanding these institutional moves is probably key to figuring out what comes next.